Cool. So I think we are having people slowly coming in. So while that's happening, I think we can get started on introducing ourselves and like talk a little bit about what's going to happen today. We all know that like cost avoidance is the buzzword for companies to stay afloat in the season, since we are having like a economic downturn, right? That's why we thought it is a right time to gain some insight into alternative ways in which we can implement this in our businesses. To basically speak about this, we have Rajiv, co-founder of Spendflo, and Sajid, regional head of Volopay, and Arne, the founder and CEO of Amalan International. Rajiv, you want to go ahead and introduce yourself?
Awesome. Cool. So first of all, thanks everyone for joining in, and really excited to have all of you here. My name is Rajiv. I'm one of the co-founders of Spendflo. And before starting Spendflo, I have about 15 years in the tech industry overall, and worked with large corporations like Infosys and Cognizant Consulting before jumping into the world of startups. Been in the startup world for about 7 years. At Spendflo, I head all GTM initiatives, and the main purpose of Spendflo is to ensure that we buy, manage, and renew SaaS for a lot of our customers and help them save up to 30% on their SaaS spends today, which is very relevant to the topic. But primarily, my expertise lies in GTM and also in working with global companies and ensuring that they are spending money in the right way. So, Sajid, do you want to introduce yourself?
Thanks for that, Rajiv, and big welcome to everyone joining us this afternoon for this webinar. My name is Sajid Bokhari. I am the regional head for Volopay for Australia. Now, Volopay is essentially a spend management platform which helps companies gain full and complete visibility and tracking over company-wide spending. Before I joined Volopay, I was at National Australia Bank, where I worked in debt capital markets, helping companies raise money. With some of the exciting things that I was involved in at NAB, and one thing that a really innovative product we created at NAB while we were there was Australia's first interest-free card for the consumer market. So that was one of the last products I worked at before jumping into the startup space, and heavily passionate about fintech, especially in the Southeast Asian geography, just because of the huge potential there to uplift businesses and consumers worldwide. So that's just a little bit about me.
Arne, you want to introduce yourself?
Sure. So yeah, my career started helping other people build their businesses. So I spent about 10 years in growth equity with Merrill Lynch initially, then with General Atlantic, and then I decided it was time to start my own business. Went to Stanford to generate ideas, and moved straight from there to Singapore. And already with the idea of Amalan, so restructuring and refinancing distressed consumer loans, and basically have been building the company ever since, which now is also has a much broader scope. So we're basically we have solutions from distressed, where we started, all the way to prime. We operate Indonesia's leading financial marketplace, and also a financial literacy game that we sell throughout Southeast Asia to insurance companies and banks.
Awesome. Fantastic. Arne, we can move to the next slide. So first of all, thanks Arne and Sajid for joining us on the webinar to talk through this very important and pertinent topic for today. Before we jump into it, I'll also very quickly talk a little bit about Spendflo. So as I mentioned earlier, we help companies centrally procure, manage, and track SaaS spends and save up to 30% of their spends on SaaS. And we are able to guarantee savings, and we are able to give 2x to 5x ROI on SaaS spends today. And we see SaaS spends to be increasing about 25% year on year on all companies globally. And we also see that from a tech stack standpoint, every employee is using more SaaS today. And we believe that this is going to go up, and controlling that would be a very prudent step to take to ensure that we are not overspending on our SaaS. So, Sajid, you want to give a quick 1 minute view on Volopay, and then we can jump into the topic?
Yeah, thanks, Rajiv. I mean, Volopay operates in the same general segment as Spendflo, helping companies gain visibility of their spend management. But where Volopay differs and where we specialize is we give complete visibility and tracking over all company-wide spending, and we give our customers the tools to manage that spending, whether it's on corporate cards, bill pay, employee reimbursements. And we found that with our customers, we've been able to save them 20 hours each month through our automation workflows in manual work that they would have to do. And of course, thousands of dollars annually because of the visibility and tracking that we give. A lot of potential fraudulent employee spending is reduced. So Volopay generally is an all-in-one payables platform.
Awesome, fantastic. So Ani, we can move on to the next slide. Yeah. So just before jumping into this pure topic of cost avoidance, etc., we want to take a few minutes to understand a little bit about what's happening at the global scale and set context around why we are talking about this and why it is very relevant today. So from a macro perspective, we see that there is a huge liquidity squeeze coming into the market today. And what is the prime reason for it? We see that inflation to have been at a 40-year high. And that is causing a lot of concerns across and turbulence across the world today, right from public markets to private markets to and this is not a trend limited to a couple of countries, but it's also a trend that we can see across the world, right? So, and when we dug a little deeper on why this was happening, actually it just took us back to the COVID times when the pandemic actually had a very, very interesting, unprecedented combination of supply and demand side shocks. Right? So the shocks spread through supply chains across the world and causing different sectors to become either demand constraint or supply constraint. So we all had, when the pandemic hit and when everybody was trying to figure out what was happening, all the producers tried to optimize their production, assuming that there is going to be a demand crunch. Okay. And when that started happening, people were optimizing their spends, people are producing lower and lower, and oil prices were also now suddenly not many people are traveling. So there was too much supply in the market. So people are still figuring out all those things. But at that point of time, there was not a huge layoff or we didn't see a huge monetary impact that was happening, right? Primarily because all governments pulled in and they started rolling out large stimulus packages. And we also had very accommodative monetary policies across the world that prevented mass layoffs and bankruptcies across the world. But once the vaccines started rolling out and people started and government started easing out all the stimulus that was provided to the market, economic activities started to pick up. And at the same time, we also saw that consumer spending, which was all, they all started saving when the pandemic started, but they started spending at a much higher rate when the pandemic was coming under control. And we've seen that the spending is at an unprecedented rate today. And that is one of the main reasons we see consumer inflation to have been scaling up consistently, right? And so what has happened today because of that is high inflation is causing banks to, or central banks to increase the interest rates. And because of that, we see people pulling out money from all other markets and be very cautious on investing their money in multiple channels. So this is something that we observed as a macro trend. And we are also thinking about it. We are also hoping that this trend is going to continue for the next few months because banks, the inflation hasn't peaked yet. So a lot of research from EBS and multiple other sources are talking about how inflation is going to peak over the next 3 to 6 months, and we can expect a few more interest rate hikes. So the situation is going to be a little more turbulent over the next few months. That is the observation that we have got. So Sajid, I would love to hear your thoughts on it, and also Arne, your thoughts on it after that.
Yeah, thanks for that, Rajiv. I mean, nothing much further to add of what you mentioned. I mean, we're seeing the same things in terms of our customer base and where we see them reducing expenses and then being a bit more cautious and where they're investing as well. But yeah, nothing, hugely different that I would add to what you've already said. Arne, do you have any insights you'd like to add?
Well, yeah, I mean, from our end, it's quite interesting, no? Because one part of our business sees kind of increase in demand when the interest goes up, no? Because people that are already financially a little bit weak, interest hike is going to push them over the cliff, and asking for our debt relief service. On the other hand, we are also helping banks and consumers kind of match the right financial products, no? And there, when the interest goes up, it gets more expensive for the consumer. Demand would go down, and also just the approval rates go down, as the interest hike will impact negatively the debt burden ratio. So it's quite interesting. So interest goes up, our business shifts more to the left, and interest goes down, shifts more to the right.
The good thing is there's always good business. So that's interesting to know. And thanks, Arne, for your inputs. And I just wanted to talk a little bit more about how companies would be reacting to this, right? So primarily as businesses, we are starting to see these trends emerge across the world. And what are the different initiatives that companies would be taking to address the current situation that we are in? So some of the common measures that we've seen companies take is they obviously shore up their capital structure. So obviously rebalance their portfolios to ensure their cost of capital is very optimally deployed to avoid any surprises, and they plan for the worst. Second, they also proactively address the supply chain risks. So a lot of businesses today underestimated the supply chain risk that is out there. Even for tech businesses today, there is a supply chain risk in terms of delivery. People were not available to implement, and multiple other risks was there, right, for them. So we figure out that you have to map your entire customer journeys, and also map your entire procurement cycles and your entire supply chain to figure out what are the areas that are prone to disruption, and always have a plan B around that. That is something that we've seen a lot of companies wanting to do. And third is build for continuity. Obviously, you need to invest more in systems than people in a lot of cases, and that will ensure that your systems are robust enough to highlight risks, and also have enable you to transition from a full hybrid workplace to a remote work or a full office workspace, or multiple ways in which people can work, to ensure we are able to deliver our value to our customers. And also we have to plan for periods of high employee turnover as well. And the last thing that we see that customers or companies doing is to consider smart hedges. So primarily making where to hedge. So pre-buying some stuff to ensure that they are not paying a lot more, looking at the way in which interest rates are rising, etc. That is also another strategy that we've seen companies do. So this is something that we've seen as reactions coming from a lot of companies across the world, and we believe that we can apply it to the startup world and the growth world as well. And that's how we came up with some metrics that can how you should look at your business today, and why you should start planning for future is something that we've realized as a framework, if we present, might be useful for people watching this webinar. So Sajid and Arne, any thoughts on this, on measures that companies take to on the situation?
Yeah, I think it's a very important time for companies to look at whether it comes to cost reduction or cost optimization. I mean, it depends on what industry, what segment you're in, the cost it is, or the cost it takes for a business to run the organization in any case. So it just varies, and it's hard to give general advice, but obviously cost reduction is one of the first things, good businesses need to look at to kind of survive through the current environment. Looking at reducing activities that don't have a very high return on investment, and things that come to mind, straight of mind, are, particularly, we see a lot of businesses investing a ton of money into channels like, paid marketing, into event sponsorship, in terms of conferences and that type of stuff. Now, all that you'll see reduce, I feel, heavily. I feel you'll see, only the big corporates will start or keep on investing in sponsorships. But for a lot of the companies and organizations at scale up stage or even startup stage, I would recommend those are the first things that need to be on the chopping block. Focusing on your customers that give you the highest LTV and that the highest contract values, I would recommend to businesses to have a look at that. And funnily enough, it is easier to increase your annual revenues, let's say 10%, by looking at your existing customer base and increasing loyalty from them, increasing engagement from them of your product or service, rather than just finding 10% new customers. So that is another thing that we see our clients doing, and ourselves, of course, doing as well. And then, of course, generally speaking, would have to be, as you mentioned, Rajiv, building for the long term. This is the time for really augmenting your product, building for any type of products or services that are required to be built for it's a cycle. So there is going to be an upcycle in any case. Building and preparing for that, and then kind of reevaluating your financial plans as well to realistic projections as the current environment demands. I think those are the main things that come to mind for me when I see how our clients have been using the platform and managing their expenses.
Great.
Yeah. Okay, so from my end, I guess cost management is something that is an ongoing process throughout the good and bad times, and a lot of this now also depends on the runway that you have. So if you were lucky enough to have raised a good round before January this year, and you have 2-3 years runway, this might be a way where, yes, you should always manage your cost and have all the transparency that you can have, but it might be a way where you can gain market share from the competition if demand is still there. No? So the key consideration is runway, burn rate, and if you have enough runway, you might be able to get really good deals on a lot of things. So now is probably the time to negotiate and renegotiate big contracts, to possibly hire amazing people from companies that have to downsize. So I think it can never be just seen isolated. No, so there is general cost savings measures. There's investing in systems and transparency, and then there is well, if you're lucky enough, then this might be an opportunity to do really great investments.
Awesome. Thanks, Arne. Arne, we can move to the next slide. So taking the inputs, we also thought that it will be good for us to have a high-level framework, at least from a SaaS world and a metric and a growth stage businesses world, to have a framework on how you should think about your business during these downturns, right? So when you talk about key metrics for businesses today, growth is obviously a fantastic metrics to have. And obviously, when you're in the market for raising funds, or when you're looking at increasing evaluation, today, what is good, great, and bad is something that we have documented here. So for growth perspective, if you are growing 3x year on year, that is something that you're in a fantastic place to be. And this is for, mind you, early stage and growth stage companies. This is not for large corporates, etc. But still, from a metric standpoint, we see that for a business to have a fantastic, to appear fantastic in front of an investor today, these are some metrics that you can look at. So having a growth of 3x, 70% margin business, and NDR, which is about 140%. This is like industry standard, right? Top notch in the industry. And 6 to 12 month payback, and a burn multiple of 1 or less. So this is like a profile of a company that investors would invest in any situation, be it a pandemic situation, or be it a downturn, or be it a bull market. So we know that this is something that is a profile of a company that would be great. But today, I think from a business standpoint, if we are reallocating our resources and ensuring that we are being at the right place to do the right things, then it is good for you to have at least 2 to 2.5x growth. and 50% margins. So invest more in ensuring that your customers are happy. So even if it takes a bit more of your margins, go ahead and do that, because that's where you will be able to retain your customers. As Sajid said, it's very critical. Your NDR at around 120%. And we have a payback of 12 to 18. This is where you're investing more on regular channels that you used to even before such a downturn happened. And a burn multiple of 1 to 1.5 is good enough, right? But you don't want to be in a bad state where we are seeing that businesses are growing slowly, but also have a huge burn multiple and a CAC and a payback period of about 24 months. This says that you're investing a lot, but the speed at which you're growing is lower. So this is not the right place for you to be in at this point of time, at least. Ani, move to the next slide. So what we realized after a lot of discussions with our colleagues in the industry and also to a lot of investors and customers is that, so gone are the days where you can do growth trumps everything, right? So here we need to talk about responsible growth. And the core metric that was used before in 2020 to 2022 in the VC world was primarily your CAC, your LTV, CAC to LTV ratio, and your growth rates and stuff like that. But now I think it is all normalizing towards the most important metric that is required for companies to raise funds, that is primarily your burn multiple. So what is burn multiple? How is it different? Your burn multiple is your ability to add new ARR, and for that, how much you are spending on a monthly basis. So it's actually net new ARR that you're adding every month by net burn. So usually when you talk about CAC ratios, you primarily take about your sales and marketing expenses, but all your other expenses are ignored. Here in net burn, your complete operating efficiency is considered, and that is why you are able to show a more realistic business. And here we talk about how the potential of a business to generate cash, right? Ultimately, the most value a company can generate is in its ability to generate cash. And we believe that the burn multiple is the most important metric today. And we've seen this to become mainstay in almost all evaluations that we undergo with investors today, right? So next slide, Annie. Yeah, so again, I would love to jump into a poll. Probably, Annie, you want to run the poll so that we can understand the audience and understand where they are, and then tailor the discussion a little forward.
Yeah, sure. So the poll is live right now, and everyone can just cast their votes.
Yeah, request all of you to fill in the poll so that we'll be able to get some insights and tailor the conversation accordingly.
Doesn't work for me.
Yeah, the panelists cannot vote.
Oh, I see.
Yeah, I think we have all that needs, like answer the poll. I'm just going to end the poll and share the results.
Yeah.
Okay.
Fantastic. We can see that the main reasons for high growth multiple, burn multiple that we see is one is low gross margin and high CAC. So this is something that we expected to see, because this is something that that's a predominant problem across the industry today. So we will talk a little bit more about how we think about burn and what are some ideas where we can control the burn multiple. So Annie, next slide, please. So in every business today, we see that there is a lot of challenges when you have high burn multiples, right? So what it does, as you've seen in the poll results as well, we already are seeing low gross margins in your business, because you're burning more in terms of your operations, in terms of your acquiring your customers and etc. That you're not able to generate enough cash there. Second, from a high burn multiple perspective, today it is very difficult for you to raise your valuation and raise VC money as well, because if the VCs are being pulled up for to invest in companies that have responsible growth, burn multiple becomes a very, very important criteria. And third is lack of capital. So as you burn more, your runway becomes shorter and shorter, and when you don't have capital, you will not be able to take bold risks or invest in areas that can give you non-linear returns. So that really stagnates or kills your business as well. So in our honest opinion, burn multiple should be the core metric that every business owner looks at on a weekly and monthly basis, so that we are able to clearly re-strategize and plan. And this also gives us an indication when we should be on the road to raise our next round of funding, so that we'll be able to deliver on our initiatives very effectively, right? So, Ani, next slide. Next, we move on to this topic of, okay, we've covered enough on the macro that it is not looking great, that interest rates are going high, inflation is very high. Second, we've also talked about burn multiple and why it is very important and how it hurts your business. Now we want to go into a little bit more on the actionable part of how you can reduce your burn rate and how savings is a strategic growth lever for you. Okay, so next slide, Ani. So before we get into that, we also thought that it will be good for us to understand the current position of how you are spending, and especially in one of the fastest growing spends in your company, which is your SaaS spends. So it will be great if you can, Ani, launch the poll and we can ask people to fill in so that we'll get the responses.
Yeah, it's live right now.
Yeah.
We have about like 6 more people still waiting to cast their votes.
Have we got the responses, Ani?
Yeah, we have about like 50% like participated.
Okay.
Probably wait for a few more seconds. Okay. Yeah, it's not going up. So I'm just going to end the poll. Is that all right, Rajiv?
Sure.
I'll share the results. Cool. Thanks.
Awesome. Cool. So thanks everyone for filling in the poll. We see that the annual spends are around 50% of the people are around less than 250K, and 50% of the people have about 1 million in spend, which is quite significant and can have a huge impact if we are able to control that as well. So Ani will move on to the next slide. Yeah. So what we've come to understand is, to control burn multiple, you need to start, you either can increase your ARR, or second, you control your spends. And to control your spends, we believe that strategic SaaS savings is a huge lever that you can use to reduce your spends. And how do you do strategic SaaS savings? One is by identifying and tracking your entire SaaS stack in a single place. So today in most companies, what is happening is, because of shadow IT, a lot of people enable business owners to buy their own tools. And the number of people buying new tools is increasing every day. And within a company, there is no central place in which you even know and track what tools are being used across the company. And this leads to a massive leakage of value for customers. And we see that because of that, there is about 20 to 30% of your spends are going waste on repeated tools and being tools that are not even being utilized by your organization. So first thing that we advise companies to do in order to get a hang of their SaaS spends and savings is to identify and track the SaaS spend, how much is being spent on what kind of tools, and who's managing those spends, and get a central repository to store all your SaaS contracts so that we can negotiate it at a later point of time. So that is one thing that we believe is a very, very important lever. Second, instead of being reactive, being a proactive SaaS buyer can give you huge advantages. So what we mean by that is, when you initially start up, you buy a CRM or a help desk or a marketing automation tool or whatever, you put in a card that you create on file and you start using that particular product. And as you grow and scale, you'll suddenly realize that the number of users on the platform is very high and you're still getting this price. SaaS pricing is very, very opaque. So which means that you will not know whether you're paying the right price for the product as well. So what we do is we help you to really become proactive about your SaaS buying, see all your SaaS renewals in one place. So start engaging in your renewal discussion with your vendors well in advance and have a negotiation strategy and a plan so that you can arrive at decent savings from your spends. So do not just spend on list price on SaaS. That is a real high waste of money in our opinion, right? And the third is, once you have visibility on your stack, you can start rationalizing your stack as well, where you can put in people using a set of tools can share licenses amongst different departments so that you also optimize for more usage. Second, people buying the right tools for the right needs is something that you need to ensure that happens in the system today. It's very easy to buy a tool, but it's very difficult for you to track whether it's the right tool and whether it's being used properly. And since procurement and finance are a little away from business owners today, it is very difficult for those teams to have control of this. So getting the visibility and getting control on your spends will help you save up to 30% of your annual expenses, right? So with this, I also will ask Sajid and Arne to share their views on how savings and getting visibility can be a great driver for customers as well.
Okay.
Yeah, thanks.
Shall I start? Okay,
Thanks,
you go.
Rajiv. You go for it, Arne. You go for it.
Okay, sure. So so I'm just getting to know Spendflo. I'm not using it yet. May get in touch with Rajiv after this, but what I am using is Volopay, and that has helped us a lot on the transparency side. So we had previously, exactly as Rajiv said, a lot of people requested a lot of tools that they said that they would use. And then if you have one kind of consolidated credit card bill per month that comes in to finance has no idea, is this being used or not? And so these things just keep going forever. Sometimes the employees have even left the company already and you keep spending. So and that was one also of the key considerations why I was looking for a tool like Volopay, and then started using it, because you can essentially structure cost by departments. So there's the budget owner is the head of the department, and then you can assign the particular tool to the user, so that the user, the head of department, finance, everybody is on the same page at the same time. And another thing that also happens quite frequently is that you, even after you cancel a contract, you keep getting billed. That's another thing that is kind of a key feature for me for Volopay, where you can just freeze the card. So we use one card per tool. It's a virtual card, it can be easily done. And then once we cancel the subscription, we also freeze the card. So there's no more charges happening after that. And yeah, so that helps us controlling the cost. And that is, however, without the part that Rajiv is mentioning, that is without actually actively negotiating the pricing. Also, we're paying whatever price usually is the standard price, but we are able to track it quite well.
Thanks for that, Arne. I think what we'll do is we'll dig a little deeper into your workflows just a little later on in the slide when we go through your case study as well. So it'd be cool to go over the visual representations of what it looked like. You know, from our end, from Volopay's, and of course, this is bread and butter of any solid business growth strategy, is knowing your cost base, knowing your burn multiples, you know, and doing everything you can to either reduce inefficient spending or, you know, misplaced spending. And part of that, in our viewpoint, is having a complete, you know, the importance of having complete visibility and tracking capability and enforcement capability on different spending policies for, it might be different teams, different budgets, you know, different countries of operation, which are really crucial to encouraging, number one, good financial discipline in the company as your company grows, because we find that a lot of our clients who are at the early stage of their businesses, the processes they use to manage finance at maybe 2 or 3 employees in size don't scale once they reach 30, 40, 50. And it turns out they're using the same tools. They tend to be using Excel, bank statements, WhatsApp messages, and all of this it's not a scalable solution. And as Arne mentioned as well, they're typically using the CEO's card to manage all kinds of spending, which becomes very difficult to understand. Where is this spend coming from? Who spent it? Who approved it? Is it legitimate? Is it fraudulent? It becomes very difficult to understand. And also because a lot of that data is not available in real time. It's typically available in your banking portal or whichever credit card provider you're using, and you mostly get access, or people or finance teams mostly look at it at the end of the month when they're reconciling their books and closing the statements for that month. So the discipline around financial discipline and internal processes has to begin early. And there are many tools in the market. Volopay is one of them, where we can help you get complete visibility and control over your company-wide spending, putting businesses in the best position really to grow and reach their full potential.
Awesome. So, Arne, do you want to move to the next slide? Yeah. So, given that we've addressed a lot of points on how burn multiple is important and why savings are important, etc., we just thought it'll be good for us also to present a couple of case studies where we've seen the real impact of how cost optimization can help companies. So I'm going to take an example of one of our customers. It's a Series B funded SaaS startups, which is growing really fast in India and across the world. So primarily they're a US headquartered company, have operations in about 4 countries and sell in about 120 plus countries today. So for them, they were having this problem of hyper growth, and they were growing really fast, and they had very little control of the SaaS spends that they were managing. So every business owner was buying tools, and every employee could request for a tool or put their personal credit card and start using a tool, and then later send it to finance for approvals and reimbursements. And they found it really difficult to track it. And suddenly their expenses were growing at about 100% year on year. So what Spendflo did was we provided them a single platform where they could centralize all their SaaS contracts. So it acts like a system of record for their entire SaaS stack, and we were able to ensure we built a renewal calendar for all their buying in one central place. We provided them approval workflows that people can take to request for tools, get it approved through their value chain, and everything was audited and logged so that people knew why a certain decision was taken and who took it, etc. And we also provided them a platform where they could collaborate with each other and buy tools better. So in our catalog, if somebody say, for example, you want to buy a CRM, you go in and you can search for CRMs, or you can look for a pre-existing tool that you want to buy. We tell you whether the tool is already being used in your organization or not. If it's already being used, whom you should reach out for additional licenses. If it's not being used, you can make a procurement request, and it comes to our buying team, and our buying team will be able to buy and negotiate that tool for you. And we also negotiated over 75 plus contracts for them over the past 6 to 9 months. And we have saved them over 400K in SaaS spends alone in the last 9 months. So this is something that we were able to give them a huge amount of ROI on what they paid us. So we saved them. So from their overall spend, it's about 30%. We are able to save for them very, very quickly. And our procurements are now happening at 3x faster because we have relationships with over 600 plus SaaS vendors. So you need a tool, you reach out to us. We are able to immediately look at and buy that tool for you very, very quickly and efficiently, and make sure that you get the best price, because we have price benchmarking data for all SaaS vendors across the world that we work with. And we've done over, say, $90 million worth of SaaS transactions alone in the last 9 months. So we bought SaaS very regularly. And with this, we are able to deliver very strong value to our customers by saving them money in a guaranteed form. If we don't hit our guaranteed savings target that we sign up with our customer, we actually give the entire money back. So that's how we structured our business. So this case study really proves that having a player like Spendflo as part of your team, augmenting your central procurement team or augmenting your central finance team, will really help you save money in a guaranteed fashion, in a budget neutral or even budget positive way for you. And that saves a lot of time, effort, and money for you. So that is the case study that we wanted to present. So Sajid, do you want to talk to Arne about your case study and how Volopay can also help in this regard?
Yeah, thanks, Rajiv. What we'll do is we'll go on to the next slide and we'll just give a quick overview of what Volopay is, and then we jump into the case study with Arne and hear from one of our customers. If you can just play, yeah. So Volopay, I mean, as I was speaking earlier, is really a payables management platform which gives you, visibility and tracking over multiple different ways to manage your payables. We offer physical and virtual cards for companies. The importance of that is then you can create cards for each vendor or each subscription you're managing. That's incredibly important because as you grow, the number of employees in your company grow, and before you know it, there are 10, 20, 30 employees all using one card for your company-wide spending. It becomes difficult to control who's spending what. We've seen a lot of customers of ours deal with double spending, triple spending. And what I mean by that is when new employees join a company, they start to buy a service or a subscription, not knowing that someone else in the company has already bought that subscription. And so because as companies grow, there can be communication silos where communication really isn't transmitted through the company, or there isn't a central finance team controlling this. Usually it might be the external accountant, or it might even be the CEO still putting all the expenses on the card. And so we've helped a lot of companies deal with double, triple spending. We've helped many companies deal with employee fraudulent spending, which is what happens often when a CEO shares their card with their entire company. But corporate cards is just one way. We help companies control spending and set up approval policies on all spend, whether it's by budget or team or department. It's up to you how you wish to use a platform where you can where the system can automate the approvals for you. Where if you're having certain spend on a certain budget or category of expenditure, the system can then send the notification to the right person depending on the policy you've set up. But in addition to that, we also help with domestic and international transfers, so invoice payments, any one of your accounts payables. We're building solutions, and we have built solutions to help companies automate that entire process. So instead of having to manually input 30 or 40 payment instructions into your banking portal, Volopay can help you automate all of that. We share email IDs with our clients where they can forward their invoices, and those payment instructions are created on the platform. And then, of course, we love to automate a lot of the accounting. So you can set up accounting triggers on the platform, where once we integrate into your accounting, whether it's Xero, QuickBooks, NetSuite, SAP, we can recognize vendor codes or merchant categories coming through the Volopay platform. And if you've set up the triggers, Volopay will recognize the vendor, match it to your GL code on your accounting platform, and then autofill a lot of the accounting for you. So that helps us save a lot of our clients between 12 to 20 hours each month in manual work. I think the best feedback we've ever received, and my favorite feedback, has been a company which told us that ever since using Volopay, they never had to increase the size of their finance team. And that is feedback that we hear quite often, where because of the automations, the approval policies, and the processes we've set up, they've not had to hire a person just to go through their accounts payables, or just to collect receipts, or just to go through the setting up and monitoring of the cards. It becomes easier for them to manage that. And of course, the employee fraudulent spending as well. But this is, I can tell you what the platform is and the benefits of it, but there is nothing better than hearing from an actual customer. So hence we were delighted to invite Arne from Amalan. He's been a long-time customer of ours, and I thought it'd be better to hear from him. So if you can please go to the next slide, guys. to give you guys a slide before this one, to give you guys a bit of background on what Amalan is and what they do. So Amalan is a leading provider of debt management programs in Indonesia. So what they really do is they help customers reduce the cost of their loans and regain control of their finances. And an important thing to note is Amalan's the only entity of its kind which has been accredited by the IAPDA. So I think what we'll do is we'll jump to, Arne, you're going to have to explain what that acronym is.
Yes, I think we should make a poll. What is IAPDA? So IAPDA is basically the International Association of Companies that do what we do, and we're the only ones in Asia. I think another important point is we're the only ones in Indonesia that have basically the regulatory backing, which is quite key, because that allows us also to manage escrow accounts with customer funds. So that kind of pretty much makes sure we're the only ones in the market. Now, I think we did this case study a few months back. Since then, we've grown quite substantially, also through 2 acquisitions. So we're now present also in Thailand, Philippines, Singapore, and our business scope also has broadened. Which now, I think, if we go to the next slide, you would imagine with that setup that we have now, things would be just even more complicated. So this is essentially how our finance and accounting was set up at the time when we started using Volopay. So group management in Singapore, a lot of the SaaS expenses would have been attached to the Singapore entity, and then operations mostly in Indonesia. There are also lots of payments to suppliers, smaller SaaS expenses, and then there's travel and kind of the typical kind of meeting expenses, both in Singapore and in Indonesia, and then a small operation also in Malaysia, also with their own kind of payments and what happened is that, for example, taking Grab. No, so people go to a meeting. They use Grab, which is like an Uber type of service here in Southeast Asia, and they would kind of, the person travels, and then it would either use a corporate Grab account, or they basically advance the money and then have to get it reimbursed. If there is a corporate Grab account, then there's kind of a high chance of unwanted fraud, because you just forget that you're using Grab privately, but the setting was still on the corporate account. If you have reimbursement, then you have like really the cost of reimbursement for $3 or $4 cost, and the kind of the administration cost of that, the booking of that thing costs probably $3, $4, $5. No? So it's quite terrible. Now, with Volopay, with the app, you have the essentially the person travels, uses his own Volopay card dedicated for Grab travel or for meetings, business meetings. Then once finished, takes the screenshot of that trip, uploads it to Volopay. So then there you have the payment, you have the expense record, and then everybody is already on the same page. Finance will just double check, will basically approve it. It goes to the accounts, and then it goes to group accounting. No? And so with this, we have essentially most of our expenses, definitely all of the card expenses and many of the bill expenses are going through Volopay. That's one platform. And then from there, everybody who needs to have access to the information, has it in real time, can approve with all the information ready. And in the end, the basically group accounting in India has already pretty much the work done. So that really made a huge difference to us. And in line with what Sajid said, it allows us to run a very lean finance department.
Thanks for that, Arne. I mean, great to hear. I hope we're still delivering value and savings to your business. Thank you, for that case study. So that was our case study there, Rajiv. So back to you.
Fantastic, and it's a great case study, Arne and Sajid. So with that, I think we are coming to a close on the webinar that we want to discuss. Arne, so we'll close it with a last poll. and then we'll open up for any questions that the audience might have. So, Ani, you want to run the poll?
Yes, it's live.
So it would be amazing if you can let us know what your annual expense is, so that we can also come and see if we can figure out a way to optimize that and get you full transparency on your expenses with Volopay and Spendflo.
And that's without payroll, I assume.
Yeah.
Yeah.
Yeah, I'm going to wait for a few more seconds so that they can answer it. All right, the poll is ended. I've just shared the results, Rajiv.
Okay. Great. I think from a spend standpoint as well, we see that we have a mix here. So we have companies that are spending about 3 million. We have companies that will do about 1 million, and some people are not willing to share the data. That's fine, because ultimately we believe from a concept standpoint, the best ways to cut your burn multiple is not by it is not that easy to increase your ARR very swiftly. But if you are willing to look at your spends, rationalize it, and optimize it by leveraging technology, I think the results are immediate and it can extend your runway. We don't need to see this news of a lot of people being laid off in multiple areas, etc. So that is something that we can really address. And we believe that that is a way forward as well for a lot of companies, because these are not core skill sets that you want to have within your company. It's better to have people manage it for you, or technologies that will help to scale these operations for you around the world. So with this, I think we've come to a close in the topic that we wanted to discuss. So are there any questions that we need to take, Abhi? Audience, if you have any questions, please put it in the Q&A bar, or we are happy to take any questions online if you want to come in chat as well.
We have one question, and we have Abhi raised her hand.
Okay, a couple of questions. Yeah, I think we can start taking those questions. So we have a question from Kalai. So Sajid, would you want to take that?
Yeah, sure. So thanks for the questions. Of course, cross-border payments is one of the core competencies Volopay focuses on, and the main value add that Volopay provides in that respect is that we don't charge the greedily high FX margins that many banks charge. So to give you an idea, Volopay utilizes the mid-market rate, meaning what you see in Google is what you'll find through our platform. What happens is that how banks and other financial institutions work is they'll use that rate, and depending on which country you're in, they'll add a margin of anywhere between 2 all the way up to 5% as a margin. So to give you an example, in Australia, they do go up to 5%. In Singapore, I think it's slightly more competitive than that. But then there are developing economies where, Indonesia, where it can be much higher than 5%, depending on which financial institution you're dealing with. So Volopay, what we do is we use an infrastructure provider in each one of the markets we go into, and these infrastructure providers charge a very thin margin on the mid-market rate, and that is what we charge our clients. we don't actually make any money on cross-border payments at Volopay. So it's a value add that we provide and like to pass on the savings to our clients. I hope that answers your question.
Yeah,
Back to you, Rajiv.
Yeah, awesome. I think Kalai has acknowledged it, and thanks for taking that, Sajid. Any other questions?
Okay, I have one. Rajiv, so for SaaS, there's price is not the only key consideration.
Yes.
So especially possibility to downsize a subscription or to cancellation, these kind of things, especially now. Imagine if we need to downsize the company and then you're stuck with double the Google Workspace subscriptions that you need. So how much value can you contribute on these non-price points?
Absolutely, and thanks a lot for the question. Because what we believe is price is just one component of any contract negotiation, right? So what we specialize in designing scaled contracts. So contracts that scale with the growth of your company. So if you are looking at options where you need to downsize and there's a downturn coming up and you want someone to go in and negotiate these contracts, etc., we are more than happy to come in and do that. So, but as you know that a lot of SaaS companies are, so even during the pandemic, a lot of SaaS companies came up with options for customers to downsize or delay the payments and delay restructure the contract in those opportunities. But a lot of customers did not have the time or bandwidth to go in and set it up in a right way that it can benefit them. So where we come in is when we look at your stack, when we look at the vendors that you're using and we look at your projections for growth and there are changes in situations, etc., we act like your extended team. We use our leverage over the vendors by giving them, by structuring the contract in such a way that we will be able to downsize pretty quickly, or we'll ensure there is an extended term that we get for payments. We restructure the contract itself in such a way that it suits your current need and we don't pay for anything that we are not using. Second thing is, we don't let that happen in a way where your tool, you've subscribed for a tool and you've not utilized it at all, but you're continuing to pay for it. So we also have SaaS tracking modules as part of the product, where we'll be able to know the usage patterns of different tools that is available in the system. And we use it on a continuous basis to come back with negotiation levers with the vendors. So if suddenly you decide to lay off 100 people, then that's a different case. But if we see declining usage month on month for certain set of tools, that's a completely different use case. So we use the data to form our opinion on how to go and restructure and renegotiate the contract well in advance before the renewal comes in, and we negotiate on your behalf to get the best deal for you. Does that answer your question?
Sure.
Awesome. So we have another question from Sriram as well. So yeah, Sajid, do you want to take it? The question's for you.
Yeah, sure. So Sriram, thanks for the question. You have a question around what I mentioned earlier about advising startups and other scale-ups not to go heavy on paid marketing. And I think the question is about, wouldn't sponsoring events by startups create more leads and brand awareness? So at the end of the day, startups succeed if they generate revenue. That's the single metric that creates the growth and success of any startup. There are multiple avenues to generate that revenue. Marketing is just one of them. And even within marketing, there are multiple channels that you can utilize to generate leads and revenue. What I was saying around sponsorships and stuff is those kinds of processes fall under paid marketing. And paid marketing, a lot of those things have very low return on investment potential. There are very long lead cycles where even if you find leads that turn up to events and conferences, what we found in our experience is that conversion from those channels is incredibly low, and they're typically not worth the investment that is, that it requires. And so brand awareness, I don't think is an appropriate thing that startups should be focusing on. I think what startups and scale up should be focusing on is more about product market fit. And the marketing efforts that do really well for startups are the ones which are free. things like SEO. SEO is probably the highest return on investment type, marketing effort that you can do. So I would say invest in good SEO. Word of mouth is another one. So customers speaking with other potential, customers of Volopay and other organic efforts. So focusing on marketing efforts that drive organic traffic. Paid traffic is always, hit and miss. Even if a customer does convert from a paid marketing channel, there is a difference between a customer that comes through from a paid marketing channel or an organic channel. Typically, customers coming through organic channels have that problem that you're trying to solve. They're actively searching for a solution. And so when they find your solution, they are more likely to engage with your product and utilize it to a higher potential than customers that come through paid marketing channels. That has been our experience. Even if customers do convert from a paid marketing experience, we've found that the engagement sometimes is not as high as organic traffic. And so we would recommend that really focus on organic channels, SEO, word of mouth type stuff. And in these environments, I feel, sponsorships, paid marketing, conference booths, all that type of stuff, really, it doesn't add to the bottom line of startups and scale-ups. I hope that answers your question. And interested to hear the other panel members' thoughts as well, Arne and Rajiv, if you guys have any differing opinions on that one.
Yeah, so I am not a big believer in trade shows and booth and all that. In our particular case, the marketplace, totally agree. I agree with you. SEO is the way to go. It's almost impossible to grow a financial marketplace with paid advertising because the search words are so crazy expensive. Now try to run an ad with credit card as a search word. For the opposite for our debt relief business, I mean, nobody else goes for these search words. And so that for us is actually a very good and very cost efficient way to generate revenue. So our ad spend pays off within a week. So it's and with a lot more to go. No? So people generally take some time to sign up, but just with the people that sign up within a week, the ad is already paid off.
Awesome. Thank you. Thanks, Arne, and thanks, Sajid, for answering all the questions. And I think we've overshot time by 10 minutes. It was a great conversation with all of you. And I hope people who listened in had some solid takeaways from the webinar as well. So if you have any further questions, feel free to reach out to any of us. Happy to connect, happy to answer questions, etc. So here are our coordinates. So yeah, thanks a lot. Thanks team for putting it together, the Volopay, Spendflo marketing teams and everyone who was involved. So really appreciate your time and effort. Thank you.
Thanks. Bye.
Yeah, thanks, Sajid.
Thanks, guys. And thanks, Arne, for coming along. Really appreciate it.
Sure.
Thanks, guys.
Bye.
Bye-bye.